Many people focus only which fund to select, but very few people ask a more important question, that how should my money be divided between various asset classes such as equity, debt, gold, silver, and even cash. That proper division of your money into various asset classes is called as a asset allocation. Now, let us first understand what is asset allocation. Asset allocation simply means how you divide your total investment across different asset classes, such as first, equity, in which you invest in stocks and equity mutual funds for long term growth. Second, debt, in which you invest in bonds, fixed deposits, and even debt mutual funds for stability. Third, gold, in which you invest in physical gold or either gold ETFs for diversification. And last but not the least, cash or liquid funds. In case of emergency, you need cash, or short term liquidity, you need liquid funds. So instead of putting all your money in one place, you spread it across these asset classes to balance growth and safety. Now, let us have a look at why is asset allocation so important. First point, it controls risk. If the equity market falls, debt, gold, and even cash will provide stability to your portfolio. Your entire portfolio does not suffer because you have invested your amount in the various asset classes in various proportions. Second point, it improves the consistency. Different asset classes perform differently in different market conditions. So, when the markets are extremes, your portfolio will not get reduced or not be as much red as possible, because you have invested the money into different asset classes. Now, the third point, it matches your goals. We all know that we have short term as well as long term goals. For short term goals, you need to allocate more funds to towards debt or cash. For the long term goals, it is very important that you should allocate the funds to equity, because equity in the long term has always performed very well as compared to other asset classes, and also the volatility in the equity is reduced in the long term. The fourth important point is it reduces the emotional decisions. When your portfolio is properly allocated, the market volatility can be easily managed because you have invested your money into various asset classes, and due to which you will not get panic and not take the emotional decisions. Now, let us take a simple example to understand the concept of asset allocation in a very proper way. Imagine there are two investors. One invests 100% in equity, whereas the other invests 70% in equity, 20% in debt, and 10% in the gold. During the market fall, the second investor experiences lower volatility because debt and gold protects his portfolio from falling, or acts as a cushion because of this gold and debt. So this is the power of asset allocation. Now, the key message from this video: successful investing is not about selecting the best fund, it is about selecting the right mix of equity, debt, gold, silver, and cash based on your goals. Now, The closing message: before chasing returns, first decide your allocation, and the most important thing is that also stick to your allocation, because asset allocation decides your risk, stability, and long term success in investing. If you have found this helpful, do like and share this video. The most important thing is that you should check your portfolio now and also check the asset allocation in that. And please do write in the comment section of this video your asset allocation. To simply understand the financial concepts, please do subscribe our channel. In the next video, we will understand how to decide your ideal asset allocation based on your age, income, and financial goals. Thank you. Thank you for now.